students, so we were discussing the chapter number 8 project appraisal, and we were solving the activity 7 in the last class. Okay, so in the last class we solved the activity 7 for part 1. We solved the part 1 and part 2. Okay, so now solve part 3, that is the calculate accounting rate of return. Okay, so assuming the printer is depreciated over 4 year, so 4 year the printer depreciation year. Okay, so how to calculate the annual rate of return? So first of all we are going to calculate the formula. So accounting rate of return, yes, for part number 3. Okay, part number 2. Okay, so let's solve part 3 here. Part 3 solve here. So for the annual rate of return for part number 3, or accounting rate of return. Okay, so what is the formula to calculate accounting rate of return? Yes, can you tell me? Yes, well done. So the formula is the average annual profit, average annual profit divided by average capital employed into 100. So first of all we are going to find out the average annual profit. So this is the, we are opening the working one for this working 2. Okay, so first of all opening the working one, so that is the average annual profit. Solve this one. What is the average annual profit? Okay, so for the profit we are going to calculate the profit. So net profit, for example, so net profit will be the, as per the given data. So we have the wages cost, we have the material cost, we have the benefit. So this is the annual inflow. Okay, so 5 lakh is the total revenue, 50,000 is the wages, and 1 lakh is the material cost, 350. So annual cash inflow is our annual benefit. So this is our annual benefit. So this is the mean annual profit. Okay, so annual benefit we can say, so this is our profit as well. Okay, but we know that in ARR we assume that as per the question, so we have another expense, that is the depreciation expense over 4 years. So we are going to calculate the depreciation over 4 years. Okay, so for the list of expense will be the, this one, net profit is equal to average annual net profit. So net profit will be the, for example, revenue revenue will be the 5 lakh less wages will be the 50,000 as per the question, this one. Then material is 100,000 less material. These are the cost 100,000, and the last will be the depreciation, which is the cost of asset is the 400,000. So 400,000 depreciation is the 4 years. So the depreciation expense will be the 1 lakh. So 1 lakh. So revenue minus cost. So these are all costs. So revenue minus cost is the net profit. So this is the net profit. That is the 250,000. Okay, so this is the annual net profit. And for working 2, we are going to find the capital employed, average capital employed. Okay, so this is the working 1, and for the working 2, average capital employed. Okay, so average capital employed will be the, so the formula of the capital employed will be the equity plus non-current liability. Okay, so but as per the question, we don't have any equity. Okay, so we will use the another formula, non-current assets. Yes, we have non-current assets. That is the uh, cost of an asset. That is the 400,000. Okay, so for the average, cost of asset, we will use this one, 400,000, and for the average, we will divide it by 2. So this will be the 200,000. So this 200,000 is the average capital employed. So this is the average capital employed. Okay, so now putting the values in the above formula. So average annual profit is 250,000. 250,000 here divided by average capital employed is 200,000. 200,000 multiply by 100. So the answer is the, yes, what is the answer? Yes. So the answer is the, okay, 125%. So this 125% is my answer. Okay, and this is the part number 3. This is the part 3. Yes, any problem in this? Okay, So now move to the next part. What is the next one? So we had done with the part number 3. Okay, in addition to the fact above, fast printing solution currently has its thicker card cut out of sheet by an outside contractor. On investigation, fast printing solution found that it could purchase a cutting machine for 300,000. So this is the cutting machine cost, which would then allow it to do this without outside help. The annual cost of new cutting machine would be annual cost would be 100,000, but there would be saving 325,000 saving, which is the most which is the amount that fast printing solution currently pays the outside contractor. Okay, so for the outside contractor, okay, so part number 4, for the cutting machine calculate the payback period. So what is the payback period for the cutting machine? Okay, and then okay, so for question number 4 part A, let's solve this payback period. Okay, so first of all, for the payback period, so what we need, so we need the cash outflow and we need the cash inflow, and cash inflow in our case will be the annual benefit, or we can say the profit. Okay, so okay, so let's solve this question. Just copy this. Part number 4 will solve here. Okay, so the part number 4, payback period. So for the payback period, so we need the firstly cash outflows. So the cash flows in our case will be the 300,000. That is the cost of the machine. That is the 300,000. So that is the cash outflow. So for the cash flow, it will be the negative 300,000. For the cumulative cash flow, again it will be the negative 300,000. For inflow, so we have to calculate the inflow. So by giving the head cash inflow, or you can say the net benefit. So the net benefit for the card cutting machine will be the, so how much saving is possible? Saving is 325 and the cost is 100,000. So 325 minus 100,000, it will be the net saving, that is 225. So annual cash inflow will be the, saving is equal to 325,000 less cost is 100,000. So this is the net benefit. Net benefit or net saving, that is a 225,000. So 225,000 we will add here, 225,000. Okay, so you can also mention this come from working number 1, and this come from working number uh, 1 in this case. Okay. Okay, so minus 300 plus 225, so answer will be the negative 75,000. Then again it will remain same for the next year. Minus 75 plus 225, it will be the positive 150,000. So we get the positive values at the year 1, at the year 1. So the payback period will be the between year 1 and year 2. Okay, so for the calculation of payback period, so it will be the 1 plus 75,000 divided by 225,000 into 100. Sorry, into 12 for convert it into the months. Yes, so what is the answer? Yes, so it will be the 1 year and 4 months. Okay, so this is 1, this is the 4 months. So this is the answer of the payback period. Okay, so this is the answer of the question number 4 with part A. So question 4, part A. Yes, any problem in this? Okay, so now net book value based on 20% discount rate. Now calculate net book value. Okay, so for the net book value we use this format. Question 4A, question 4B, we write here. Okay, so what is the requirement for the net present value? Just remove these cash flows. Okay, so let's check out how many years we are going to calculate the net present value. Just read the question. uh the net book value. Okay, so for how many years? Yes, read the question. mm, Question number 4. Okay, so there is nothing, no, there is not given in the question for how many years we are going to calculate the net present value. Okay, so based on the above assumption, because in the upper question we calculate the net present value for 4 years. So based on these assumptions, so we will find the net book value for 4 years just to match with the upper question. Okay, although it should be written over there that you have to calculate the net present value for 4 years, because there is no information given in the question, so we just assume this as per the uh, previous data. Okay, so we are going to calculate the net present value for the 4 years. So what is the cash outflow? So cash outflow, we know that in our case, as per question number 4, is the 300,000, that this one cash outflows. Inflow is the 225,000. Okay, so year 1 225,000, year 2 225,000, year 3 225,000, year 4 225,000, and the depreciation rate will be as per 4. Oh yes, it's remains same, so we can copy this one, because it's remains same 20%. So yes, we can copy this. Okay, okay, now so what is the answer? So multiply 225 multiply by this is equal to answer. Yes, tell me the answer one by one. 187,493. Second one, 156,240. Third one, 130,208. And the fourth one, 108,518. Okay, now let's total, grand total. So here will be the net present value. Yes. Oh, sorry, I forget to write minus 300,000 here. Okay, now let's multiply. Sorry, let's add and subtract, and tell me the final answer. 282, sorry, 282, 282,459. So this is the positive net present. Yes, 454. Okay, 459. 8 plus 8 16, 16 plus 3, it should be 9 technically. Okay, just write 4, just write 9. It's just a rounding difference. Okay, so the net present value is the positive. Okay, so this is the my answer for the part number 2. Yes, any problem in this? Okay, so now it will be the last part, that is the part C, ARR, accounting rate of return. Okay, so for accounting rate of return, we will copy this one format. This format we already made accounting rate of return. Yes, this one. Okay. Okay, so for the part number 3, accounting rate of return. Okay, so we use this formula. Okay, now we are calculate these answers. Okay, so yes, so revenue, what is the revenue in our case now? What is the revenue in our case now? Yes, 325,000. So this is the revenue, this one. This is 325,000, and cost is 100,000. Okay, so cost is 100,000. So that is the cost. And now depreciation. So revenue less cost. Okay, so less depreciation. So again, the depreciation is for 4 years. So the cost of asset, what is the cost of asset? 300,000. Okay, so 300,000 divided by 4. Okay, yes, what is the depreciation amount? Yes, 300 divided by 4. It will be the 75,000. Okay, okay, so now subtract all these, then we will get the net annual benefit. So now it will be 150,000. So 150,000 is the net annual benefit. So we will write here 150,000. Now average capital employed. So average capital employed is very easy in our case. So cost is 300,000. So just 300 divided by 2, it will be 150,000. So 150,000 is the average capital. Okay, so 150 divided by 150. So now it will be the 100%. So 100% is my answer. Okay. Okay. So now move to the next part. Part number 5. As was printing solution doesn't have sufficient fund for both new printer and the card cutting machine. So we have two machines. Number one for new printer, and second one is the card cutting machine. So advise the company on which machine to purchase. So what is the advice to which machine to purchase? So either to purchase the printer. So this was the story of uh, printer, and this was a story of cutting machine. Cutting machine. Yes, so which is more suitable, printer or cutting machine? Okay, so for the analysis, which one is better? So okay, so we just compare both. We just compare both. So for comparison, I just make these some charts. So where we draw the ARR. So ARR, then net present value, then the payback period. Okay, okay, so here will be the analysis. Okay, for the analysis, okay, So here is the machine. Now analysis, which one is better? So machines, payback, NPV, ARR. Okay, so for machine one, that was the printer. Second one, cutting machine. Okay, so second was cutting machine. Cutting printer machine, cutting machine. Okay, so for printer, yes, payback is 1 year 7 month. Okay, 1 year 7 month. Payback 1 year 7 month. Or for NPV is 506045 506045 506045. ARR is 125%. 125%. So 125% is the ARR. Okay, now so for the cutting one, payback period is 1 year 4 month. 1 year 4 month. So 1 year 4 month. NPV is the 282459. 282459. And ARR is was the 100%. 100%. Okay, now decide which one is better. Cutting one, okay. But as per my point of view, so for cutting one, so when we compare payback period, so which payback period is higher? New printer or cutting? Sorry, lower one. Sorry, lower one. So for cutting one, uh, it's the winner. It's the winner. For payback period, cutting payback period is better. Okay. When we compare NPV, so which NPV is better? Okay, so now it will be tie, it will be the tie situation. Okay, so for payback, cutting is the winner. For NPV, new printer is the winner. Now ARR will decide which ARR is higher. So now new printer ARR is higher. Okay, so now you can see new printer has 2 vote, cutting has only 1 vote, so 2 is the winner. So it's mean new printer project is favorable. Okay, so decision is new printer, new printing machine will give us the best result, will give the best return. Okay, although cutting has the lower payback period. So this is our decision and the question is completed in all aspect. Yes, any problem in this? Okay, so you want to note anything? Okay, okay, note it. And you have to learn how to make a decision. Okay, so now you compare every one project appraisal method one by one, and then check which asset has the more uh, favorite. This is the part 1. Okay, just synchronize this. I just give me a minute. This is the part 1, part 2, and this is the part 3. Okay, now it's synchronized, and this is the for new printer. Okay, so okay, I send a screenshot on your WhatsApp number. Okay, then you may note. Okay. Okay, so it's enough for today. So the next will be the activity 8 is for your homework. Mark this activity as a homework. 9 will be your homework. 10 will be your homework. Okay, so now in this we had finished our completed our chapter number 8. Okay. Okay. Okay, so in the next class, so if you are unable to solve any activity, then we solve that activity. Otherwise, we move to the next chapter. Okay. Okay, students. So take care of yourself.